Earnings season's getting ready to kick off. We've got the Fed coming up here in a couple of weeks. You got CPI, PPI at the end of the week. You and I have all kinds of stuff to talk about is the bottom line here. And I want to pick your brain on some AI stocks because everybody is hot on that. So let's start with something real quickly. Let's hit the politics, all right? We've seen a huge couple of weeks here, right? I mean, I don't think anybody saw things turning out the way they have. And you actually got a lot of people that are starting to posture here as we look, 4 or 5 months away from the election, the actual election happening. Do you think the market is really getting subtly pushed around by what the expectations are? Or do you think we're still seeing people sit on the fence?
I don't think the market has yet seen an impact on what's going to happen, I think. And I think it's going to be disruptive. I hope I'm wrong, but I have a somewhat bad feeling that we may be in for something like the summer of '68 in the infamous Chicago convention in '68 and the riots, et cetera, because markets haven't priced in what I think is going to be fairly evident, which is disinformation. And, I think it's going to be evident in the sense that people are going to be like, wait a second, he wouldn't normally say that, or he wouldn't say that, or that can't be really what they think, or that party said. And I don't know if we're going to be able to discern the truth from the propaganda. And I think that's going to create problems. I think Biden will maybe be pushed aside before the convention. I think they'll decide at the convention who the nominee is going to be for the Democrats. And the market hasn't priced any of that in yet. I think investors obviously see what the possibilities are. Right now, we're just continuing on the high of we started last November, and it's the AI narrative. It's the earnings are better narrative. It's really, there's nothing out in front of us. There's no cliff in front of us that we could fall over. And all of the things that seem to be problematic, the market just seems to be eating up and spitting out. And so the election could change that. And I think it's probably going to be closer to the end of the summer, early fall, before we start to see any impact, if we do.
Let's hit back on something, because you just said something key. AI. Is AI just more important than the election right now for investors? I mean, that's kind of the way it seems. Like we're not taking our lead from what's happening on the political scene. We've seen geopolitics that over the last year probably should have had a bigger impact. Is it just because there's a great shiny object out there with AI?
Yeah, that shiny object happens to be actually a constellation, and in fact, a universe of AI. So this is the future. We're already in it, and we know it's going to be exponentially different because of AI. So that's what we have to look forward to. That's where we're at right now. And that's what investors are focusing on. And that's what they should be focusing on, because it's about AI. And if anybody hasn't figured that out yet, come around, because the future is AI. As far as we can see it.
Let me play the devil's advocate with you. And first of all, I got to point out something. When you say the summer of '68, I don't have that much memory of that because I was 4 months old. So anyhow, let me go back to AI.
Well, I do.
My point being. So anyway, think about this for a second. You've got large cap technology stocks. When we look at Microsoft, when we look at Amazon, I mean, we all know the Mag 7, and I guess Tesla is working its way back into its good graces here over the last 10 days, up 40%. I got a really funny question for you that Bill Gross said something funny this morning about it. But when you look at this group of stocks, it is such a small universe. It's $1 trillion club, and then the ones that are close to $1 trillion club. We have never seen, or at least in my looking back over the last couple of years, you've never seen this much concentration on one group of stocks, right? They have shouldered all the work for the market. If you look at what happened over the last couple of weeks, Nvidia's taken a little rest, a healthy correction of 15%. Maybe it's ready to go again. Can this group of stocks kind of maintain this status where they have to lift the rest of the market? Otherwise, I mean, at some point, there's got to be a proof point for holding something beyond the Mag 7, right?
I don't know that we need a proof point. I think the proof is in the pudding, and the pudding is AI, and it is technology. That's where the growth in revenues is coming from. That's where the growth in earnings is coming from. And so it's wholly justified. And it's not the first time. I just read a wonderful report from Bridgewater. I didn't agree with it entirely in terms of what the conclusion was, but really they talked about this isn't that unusual because for long ago you had the railroads. May not have been one or two companies. It was the sector. Then you had autos. Then you had chemicals, and then so you've had sectors that have led the market, that have carried the rest of the market. And then as the economy continued to grow under whatever those different leadership groups were, then you had a broadening out. But it's not unusual to see a tight leadership group lead the rest of the market and leapfrog what everybody else is doing in terms of their stock price. So it's not that unusual, and it's wholly justified in terms of what the potential earnings are for these companies. Investors are smart. They're paying up. The multiples don't quite matter if the earnings fulfill the PE ratios. And they've been doing that. So investors have been rewarded for paying up for earnings because those earnings then come about. And in, say, NVIDIA's case, handsomely and then some.
Right. And I think we're looking for 9.3% if you look at the S&P 500 in terms of earning growth year over year. This coming quarter, we're going to kick it off on Friday with the banks, which is healthy. I think that's the best in 2 years when we were up around 10, 11%. And we ran into a little bit of a bear market scenario there, but that was a lot of things coming into play. Let's go on that AI thought for a couple of seconds. You said this and you call it a universe, and I love that idea. When you talk about a universe, there are other planets, right, that are part of that. AI services is that group that I think you see the next, the automobiles or the housing industry, is that the next group of companies that are going to kind of ride this wave that is being generated? Think of NVIDIA as the boat, that's pulling them along. Is that truly where it's going to happen? Because we saw, think about it, Salesforce.com last quarter, which is one of those AI service companies. They came out and said, hey, companies aren't as quick to sign as they were 6 months ago. IBM did the same thing. Palantir, a little bit of the same thing. What do you see with that little orbit, these companies that are in orbit around the AI stocks?
The reason AI has longevity is because the take-up time is not what everybody thinks. Everyone thinks it's going to be almost automatic. It's not. It's going to take time, and that's going to give it a long, long, long run. So these companies that are, it's a big expense. Something I read the other day, which was wonderful, was that, and I think it was from Coatue, from the hedge fund, and I forget the managing partner's name, I apologize. He was talking about, since the beginning of technology, as far as CPUs, $100 trillion has been spent. That has to now move to GPUs. So can you imagine the kind of expense that companies have to incur to move the needle over to what's new, what they need in terms of AI? So there's going to be a lot of spending, and companies some are going to adopt that the higher expenses sooner, and they're going to do better sooner. And others maybe going to take a little time to start to build up what they need to do. It's going to be expensive, and not all companies are going to rush in at the same time, and not all of them have the money or are willing to basically really throw down on what is necessary to move into that universe. But they're all going to have to, by hook or by crook. So, okay. And this is where the opportunities are. Some of them look like they're not going the direction. No, they're just going to take a little longer to get there. And so if the prices of some of these companies look like, well, they're not really performing, they're not really catching in the AI buzz, no, they're going to. And those are where the opportunities are going to be, because some of those are going to look, I would say, inexpensive relative to where they could go when they incorporate and actually monetize the AI that they're going to incorporate through their ecosystems. But yeah, well, everybody. Number one, I think, is going to be healthcare, medical. That's going to be the number one where we're going to see it first and foremost. We're going to see it in everything, really.
Okay. All right, I'm going to come back in a couple of minutes and hit you with some of your favorite, the buy this, not that. And we're going to focus on the AI groups. I love the list that I've got here for you. And I might throw a couple extra in just as curveballs. Let's talk about earnings season, because I just mentioned 9.3%. It kicks off Friday, and we're going to see the big banks reporting in. You've got Morgan Stanley, Citigroup. Everybody's lined up for landing here. Anything you're looking for from the financials right now, or is this just going to be, because typically they usually try to set the tone. We don't have big tech until the end of July, early August. Anything you're looking for specifically in the financials?
I agree with you. They do set the tone. The only thing I'm looking for is if there's any disappointment. It would have to be broad-based disappointment in order to interrupt the rally. Right. I think we'll get very supportive financial earnings, probably across the board. And especially in trading, I think trading should be robust. It seems kind of quiet, but a lot of these. I've been on a bank trading desk, and these guys, they're pretty good at riding trends. And I think they're going to do well. Probably fixed income, commodity, and currency trading should do well. There's been some volatility in both commodities and currencies. And if they get on the right side of that, some of those numbers should be very robust. I think that's going to set the stage for, earnings are good. And if financials are good and no loan loss reserves are shocking, and there's no set aside necessary, I think they'll probably be, if they start to take some of the reserves they've set aside and put them back on their books, then that's a real positive. That means the consumer is in a good place, and that is, those are the kinds of things I'm looking for in between the lines, between the headlines. I want to look at the books. I want to see how many, the loans that are made, quality of the loan book, and delinquencies. All those kinds of things are important to tell us where the consumers are, and credit cards. All of those things are, I would say, granular for the most part, because they're not really headline news. But when you dig into the financial earnings, those are the things that investors should be looking at. Those are the things that I look at, and I think they should all be pretty good. So if there are surprises, and they'd have to be multiple surprises to the downside, then I think it should be a positive for the market, because, again, I look out over the horizon. I don't see any plateau. I don't see any cliff that we could fall off of.
Right. Do you expect to hear anybody talk about interest rates on these calls with the banks? Because that is you've mentioned consumer, right? And then we need to see the strength of the consumer. That is the one thing I think that right now everybody's going to be watching. The interest rates, banks are going to start to give us some expectations on what they see and how they're managing that over the next 6 months. You expect that to be a bigger picture? What's the biggest message out of the banks? Is it that we expect interest rates to come down? Is it the status of the consumer, or is it just that the banks are in good shape? I mean, is there anything that could come out of this that would just rock the market up or down?
The only thing that would rock the market is if loan loss set-asides were surprisingly high. That's the only thing. Otherwise, no, I look for good positives across the board. Again, I don't really see anything on the horizon. As far as interest rates, yes, of course, they will touch on interest rates, but let's be clear about something. No one is talking about the fact, whether you want to talk about R star or what the neutral rate is, or interest rates being higher for longer. The economy has withstood these higher rates. Financials have not only withstood them, they've made good money, and the earnings have been great on them. So we are already, I think, at a level where these rates, if they remained here, I don't think there's a problem. There will eventually be a problem if they stay elevated for a lot longer, where consumers were going to, start to have to borrow more, and the cost of that borrowing is going to be more difficult for them. And then I think we could see some consumption slow down. But right now, the economy, financials in particular, have managed the higher interest rates very well, and so it's not a problem for them.
Consumers, let's take that interest rate and go flip it over to them. You're seeing some of those companies that are, historic for the rule I've got is if you sign a piece of paper to buy it, it's going to be affected by interest rates. And by that, I mean, take out a loan, whether it's a camper, a car, a house, whatever, big ticket items. We have seen resiliency there. There have been reports here over the last 2 weeks, though, that we're starting to see those credit card accounts going higher and delinquencies are cutting back a little bit. So any thought on the consumer at this point as we, we're not going to get a read on consumers until the second half of earnings, but any thought here on how that resilience, is this just let me put it this way. They have, kept up with higher interest rates. The Fed at some point is going to start to indicate that rates are coming lower. Is it just going to be game on for the consumer discretionary stocks again because everybody is just waiting to spend money on houses and big ticket items?
Well, housing's a separate discussion, but as far as consumers, as far as their ability to spend, it's kind of sort of like kicking the can down the road. They're going to continue to spend, and whether they have to go to buy now, pay later, which we're seeing people do for groceries, and that's concerning, if not tragic, and that's where things are for a lot of Americans. But still, things are being bought. The spending is still strong, and we're going to have its up. It's going to have its ups and downs. But again, the consumer remains resilient, and until that changes, the trend is your friend. If consumers continue to spend, if they have to borrow to do it, and delinquencies start to rise, doesn't mean that that game is over and we fall off a cliff. It just means be attentive to that. Things might eventually start to slow down, but until they do, until we see spending turn around, or for me, they would have to turn harshly negative, like spending drops, like 2-3%. That's concerning. Until we see something like that, no, it's just just dig in and keep climbing higher, add on to the debt, spend, and that's the American economy.
Yeah, it is. It is, sadly, but you're exactly right. All right, let's go one step back and go back to the AI stocks, because I know we're getting close to our time here. Let's bring it down, and I'm going to pitch one more in there. This is from this morning's headlines. Bill Gross, remember of PIMCO fame?
Of course.
Bill Gross called Tesla a meme stock this morning. I don't know if you saw the news.
I didn't see that.
Tesla shares are now up 43% over the last 10 trading days. This stock has ripped higher. I think you've seen it. Everybody's watching it. There's your chart, right? This stock has taken off and gone over $250. I looked at the options market a couple days ago, and you've got a lot of speculations the stock's going to go over $300. I recall that this stock, the company gave us a pretty bad earnings report last quarter. The deliveries that they just gave us were under Wall Street expectations. Is Bill Gross right? Is this turning into a meme stock situation right now with Tesla?
He's right. Years ago, before they were profitable, they were a meme stock, in my opinion. But it was a hard bet. If you bet against them, it was kind of a widowmaker stock. Things didn't make sense until they were profitable. Then things started to make a lot of sense, and then the stock actually acted as it should. Now, again, with the deliveries, the last report, unimpressive, to say the least. And the stock got above 200, and then it just took off. A lot of short covering, obviously. A lot of hedge funds have been shorting Tesla, and they haven't been shorting the stock so much as doing it in the derivatives markets. And so a lot of heavy betting against Tesla in the derivatives that had to get covered. And so we've seen this move. That if you look at that chart, that's
stunning
stuff. That's meme stock stuff.
It is stunning. I mean, there's your move right now, 42.2% from where we were sitting right at the end. And there have been some comments here, and I think this is what Bill is alluding to, the fact that Elon Musk has come out and said, there was a headline I think it was last week, on how Bill Gates was going to get crushed because he was short Tesla stock. I mean, I think it was Bill Gates is going to get annihilated. So I think you could see a little bit of roaring kitty in Elon Musk in terms of these comments. But so would you categorize this as just the crowd moving to one side of the boat too quickly? Or is this the new beginning? Is everybody catching the falling knife correctly here?
No, I think I like the way you just put it. This is everyone moving to the one side of the boat, and eventually, you know what happens when everyone does, it's going to tip over. And so I say for the folks who are in Tesla, enjoy the ride, but it's going to come to an end at some point. And you look at that space below that move. What has to fill that space? Much higher deliveries, better earnings. And that's not in the offing. That's not in the cards right now for Tesla as far as as being an automotive company.
Right. There's your monthly chart, just so you can put it into perspective. Here's the stock trading around $400, way up there. I mean, we're at the stock rate there. That's a 20-month moving average. That's that line that I use as a long-term bear market indicator. So we've popped up. We have seen this rodeo before, though. If you look at the beginning of 2023, stock went from $100 and it went back up almost to 300, and then rode it all the way down to 150 and a little bit lower. So yeah, I think you're right. It is be thankful for what you've got right now, but keep your eye on the road here. No pun intended.
If you're riding that train, the Tesla train, make sure you have your stops in.
Yeah, exactly. All right, let's get to my favorite part with you. I like to do this every time we talk. Buy this, not that. We're going to do the AI version. I got two different stocks on each one of these. These are mixing them up a little bit. Dell and Hewlett Packard, HPQ, both of these stocks have been on a run as they've kind of jumped into that super microcomputer group, let's call it, with along with NVIDIA. So these are the servers, and Dell has done a great job. So has HPQ. Both of them taken off. Which one?
Okay, I'm glad you're pulling up the charts. I'm checking out the charts and I'm looking at some numbers. I'm going to go with. I'm going to go with Dell. And I'll tell you why. Because as far as profit margin for both these companies are pretty thin. Dell is I think like 4% profit margin. I think Hewlett is maybe 5 something. So they're pretty thin. And when you look at these statistics and the metrics of these, I'm not impressed. What's unimpressive and the reason I like Dell over Hewlett is the quarterly revenue growth at HPQ is flat, if not slightly negative, and the quarterly earnings growth year over year is pretty negative. So I'm not inclined to look at that and go, well, then maybe they could turn that around and that can become a good buy. I just think Dell is a better opportunity. Its quarterly earnings growth is year over year is up 67%. So go with the winner.
And you've got a 6% increase in revenue year over year last quarter, and that's coming off a string before that of 7 quarters in a row of negative revenue. So Dell is kind of a little bit of a turnaround on the revenue and earnings here. I like it. All right. Second, NVIDIA or super microcomputer.
Oh, good one. Wow. Okay. As far as buy this, not that, I'm going to say both of them are buy.
There you go.
You've got the chip maker, and then you've got the server side of things and storage on the super micro side. So, yes, both in the right place, right time. If I was going to allocate some capital, I would put I would say 2/3 of it into NVIDIA and 1/3 of it into Supermicro. But they're both positioned really well here. The numbers are great for both of them. You're talking about quarterly revenue growth and quarterly earnings growth.
Yeah.
I mean, it's spectacular for both of them. Let me just real quick, let's see. NVIDIA is like 600 something percent, but a Supermicro quarterly earnings growth year over year, 368%.
Yeah. So they are definitely
winners.
Yeah. All right. Let's go old school with our last. And both of these could be part of the AI movement. One of them is an AI company or AI services. The other one's trying to nudge itself into the chip industry. Intel, which traded at $30 last month, $30, Shah, and they're bringing in billions from the government in terms of trying to get them helping in building those manufacturing plants here in the United States. So Intel or IBM. I think IBM is the original. It's the OG, I call it, of AI, because remember, they had Watson way before NVIDIA was ever around.
Wow, that's a tough one. I look at Intel as an opportunity. You look at that chart. To me, that says, okay, risk reward wise, I'm willing to plunk down money on Intel down here. It's a longer term trade. You could buy leap call options on it, and you'd do just as well. But I'm going to have to go with Intel over IBM, because I just think it has more room to move.
I agree on this one. I love this Intel, and I've been beaten up on this. I'm a long-term holder of it, just for that full disclosure. And I love that you just said leaps. I do have 2026 leaps on the stock. And it is just now moving into right there is that 20-month moving average.
What's your strike, if I may ask?
Right now, so I bought the 50s a while ago, and then I did and this isn't investment advice, I always like to say that, but I started actually bringing down, I stepped down to the 40s and then the 35s as I dollar cost averages into Intel on this ride down. So I, in essence, have leveraged my dollar cost average strategy with those leaps. So now,
in a word, brilliant. I think you're going to hit a home run with that trade.
Well, I appreciate the feedback, certainly coming from you as well. All right, any last minute ones to throw in here as a curveball? Any stocks you've got up your sleeve?
No, it's folks forget sometimes the old school stocks that are still a buy and or a hold. One of them, which we put into the Manward Money Report last month, is Western Union. Western Union, but the numbers are great. The dividend is fantastic. They got plenty of money to pay the dividend. And for years, I used to park capital that I wasn't using when I was looking for places to put it in Ford, because I had a huge dividend and I understood the volatility of Ford, and I was collecting crazy yield on Ford. Western Union presents a similar opportunity right now. And I think you can get 7.5% on Western Union, just parking your money if you're looking for the next opportunity and you got cash on the sideline. The interest rates have come down as far as CDs, and money markets are coming down. But you want to get 7.5%. You want to with a stock that I don't think is going to be too volatile. I think Western Union is going to consolidate down here, and I think it can go up nicely. So I think investors need to look at positions like that make sense because of the yield. Yield is back. Yield is important again.
Oh, we're going to have to save that. We'll go into a yield hunter style conversation on our next time we get together, because you're right. We've been getting 4.5%, 5.5% with American Express and all these savings accounts. That's coming down. The clock is ticking on those high rates, and everybody's going to start looking for the deals out there where they can go back into dividend yielders and get some money. You know what, Shah, you reminded me with Western Union. If you look at this is a monthly chart of Western Union back in 2008, 2009, when we hit that, right up when everybody was running into that recession. It was like a basic idea or a thought that, hey, this company and others like it that are just wiring money, getting money from one person to another, they're going to do well because people are sending money to each other all over the place when times get tough, right? And that's exactly how it played out. I love that trade on Western Union. 7.5, 7.57. That's great.
Yeah.
All right, buddy. I appreciate it. Always great talking to you. Let's get together in the next couple weeks again and give some people some more information. Great information. Tell them where to go to check you out.
Well, you give most of the spots, but I like totalwealthresearch.com. Maybe you can go there, and that's all my free stuff. And there's a lot of content there, folks. So I think totalwealthresearch.com is a great landing spot for you. And CJ, thank you. I look forward to our next chat.
Thanks a lot, Shah. Have a great day.
You too, mate. Thanks.